Okay, welcome. Today we'll be dealing with the valuation of inventory. Okay, say for an example, we have a business called GOLE Ltd. Then GOLE Ltd, it sells calculators. Then at GOLE Ltd, what we do, the first step, we go to ShopRite. We purchase or we buy calculators. Let's say we bought 10 calculators. Then remember, this is GOLE Ltd. The purpose of this business is for selling calculators. Then say the first step, we went to ShopRite, we bought 10 calculators, and then we also went to Pick and Pay. We also bought 20 calculators. Let's say for an example, at Pick and Pay they were costing less, so we managed to bought in large numbers, so we bought 20 quantities of calculators. Then now we are step number 2, we are selling now. Let's say we happen to sell only 15 calculators. Okay, remember, how many calculators did we have in total? We bought 10 at ShopRite, we bought 20 at Pick and Pay. Then we had a total number of 30 calculators. But out of these 30 calculators, we happen to sell only 15 calculators. It means now we are remaining with how many calculators? With 15 calculators. To get this 15 is simple. It's just 30 minus 15. What we have minus what we have sold. We're remaining with 15. Then from there we continue. So we are saying this is at the end of the year. We are remaining with 15 calculators. Now we need to value these calculators. Then we have two methods. Which are used to value for these remaining units. The first one that we'll be dealing with today is this one called Fifo method. Others they call it Fifo, but I don't know, maybe they're trying to be smart. I call it Fifo method. Then we also have the second method, which is called weighted average method. With weighted average method, we'll explain everything when we get to it, but as for today, let's focus on Fifo. Okay, say for an example, let's first talk about Fifo method. Fifo stands for first in, first out. This is an assumption which says the stock which was bought first will be the stock to be sold first. First in, first out. First in, we are referring to when we were buying. First out, we are referring to when we are selling. So this is just an assumption in general. We say the stock that was bought first will be the stock to be sold first. Then let's create our own example. Okay, we're using GOLE Ltd. We're using GOLE Ltd. Then these are the transactions in GOLE Ltd. This time we'll use dates. Let's say 1 March. Let's say our financial year ends on 31 December 2017. To make it simple, 1 March 2017, we went to ShopRite. We bought 20 calculators. And each was costing 100 rand. Then on the 2nd of March 2017, we went to Pick and Pay. We bought 10 calculators and each was costing 110. Then on the 27th of March, I don't know why we were happy, but we bought 40 calculators. We bought 40 calculators and each was costing 50 rand. So I think the reason why we bought 40 calculators in this state, on the 27th of May, is because maybe they were costing less. So we don't know. we bought 40 calculators and each was costing 50 rand. So now we are coming to our sales. Our sales now is when we are selling. We sold, let's say we sold 30 calculators. We sold 30 calculators. Then if you want to calculate the value of closing stock, the first thing that you have to do is to calculate the number of remaining stock or the number of inventory on hand. What do we do, or how do we get it? We are going to say your purchases. It's when you are purchasing your stock, then you subtract your what? Your sales. We are talking of the units here. We are talking of the units. Okay, to make this simple, sometimes we have a situation whereby we have an opening inventory, but for these purposes, on our second example, that's when we'll encounter for things like opening inventory. But for the purpose of this, let's assume that we don't have opening inventory. Then it's purchases minus sales units. How many units did we purchase? On the 1st of March we bought 20 calculators. Then on the 2nd of March we bought 10 calculators. Then on the 27th of March we bought 40 calculators. Then in total it's 40 plus this, it will be 50. Then we have a total of 70 calculators. But out of these calculators, how many did we sell? We sold only 30 calculators. So in order to determine the remaining number of calculators, we are simply going to say 70 minus 30, and 70 minus 30, it will give us 40. It means we have 40 units on hand. Now remember, we are using Fifo, which stands for first in, first out. It's an assumption that inventory that was bought first will be the inventory to be sold first. So we want 40 units. So we go back to the information to our transactions. How many units did we sell? We sold 30 units. So it's a first in, first out. It means out of these 30 units, okay, let's go to our transaction. Transaction number 1, we bought 20 calculators. Remember, how many did we sell? We sold 30 calculators. It means these 20 calculators, we sold all of them. So we crashed them. We sold all of them. How many are we left with? We're left with 10 to make it 30. It means on the 2nd of March, these 10 calculators that we bought for 110, we also sold them all. Now we are remaining with this 40. It means for the 40 units which are on hand, we are going to use 50 rands, which will give us 40 multiplied by 50. Then it will be simple. You will use your calculator. Thank you.